Quantitative technique and new methods for analyzing big data have increasingly been adopted by market participants in recent years. This includes computerized trading, use of big data, and machine learning or artificial intelligence. Big data and machine learning have the potential to profoundly change the investment landscape. As the quantity and the access to data available have grown, many investors continue to evaluate how they can leverage data analysis to make more informed investment decisions. Investment managers who are willing to learn and to adopt new technology will likely have the edge. Machine learning and artificial intelligence may unleash new insights. However, investors need to better understand the current landscape and applications for the data analysis before making significant investment in the technology. So how will big data and machine learning change the investment landscape? The change to investment landscape will be profound. Big data will give an edge to quant managers who are willing to adapt and learn about new data and new analysis methods. Machines have the ability to quickly analyze news feeds and tweets and process earnings statements, scrape websites, and trade on all these instantaneously. Big data and machine learning strategies are already eroding some of the advantages of fundamental analysts. Equity, long-short managers, and macro investors and systematic strategies will increasingly adopt machine learning tools and methods. The transactions won't be without setbacks, though, as certain data may have no value and more complex techniques don't always produce better forecasts. Now, analyzing new data sources. Signals could be found in data generated by individuals, business processes, and sensors. For individuals, some examples would be sentiments from news articles, Facebook, Twitter, etc. For business processes would be credit cards using data. For sensors would be satellite imagery of mining sites and company parking lots. New techniques. As data sets get larger and more complex, investors need to use sophisticated data analysis. These tools used for these tasks include machine learning, drawn from traditional statistics, or deep learning, inspired by the human brain. These techniques could be used to analyze data and design trading strategies for financial firms. One of the new techniques used in financial firms is supervised learning, which is a subset of machine learning, using a historical data point as a training samples to infer a rule or an equation capable of predicting future outcomes. For example, an algorithm that can evaluate the best momentum signal for predicting future market performance, or to try to predict how much a market will move if there's a sudden spike in inflation. Next technique is unsupervised learning, aims to identify common drivers behind the data points by identifying relationship between input variables. For example, a successful algorithm can find that at a certain point in time, the market is being driven by a variety of factors, such as momentum factors, energy prices, the level of US dollar, etc. Some of the key points and key takeaways that financial firms and financial advisors can benefit from this is investment managers who adopt and learn about new data sets and methods of analysis will likely have an edge over their competitors. Regardless of the timeline of these changes, analysts, portfolio managers, traders, and CIOs will need to be familiar with big data and machine learning developments and related trading strategies. Both fundamental and quantitative investors will leverage big data and machine learning across asset classes. Machine learning algorithms cannot entirely replace a human intuition or understand complex long-term investment trends, but is good for financial firms and financial advisors to adopt early and go with the trend.